All right, so I think the key phrase there is almost always. Give us a sense. What do you take? What's your take on BMO's take that we're on pace? We're seeing signals for another rally.
Well, there is a lot of good news and there's a lot of momentum. And there's been whispers of lower inflation, and that means the Fed can take its foot off the gas pedal and stop choking this economy. And all that is good. We're on board. We're investing. But I think if people just think it's a one-way market and happy days are here again, uninterrupted, I think they should just be a bit cautious. We do want to see what quarterly earnings are going to look like. We want to see continued lower inflation print closer to the Fed's 2% target. There are some global factors that are still out there that are concerning. So yes, we're optimistic. We're in line with BMO's thinking, but we think that investors should still stay within their risk profile.
All right, Mark, walk me through this one. You say you want to see how earnings are going to turn out. We just are kind of wrapping up earnings season right now. We've had over 95% of companies reporting. I'm looking at the numbers right now. EPS 7% higher year over year. What else do you need to see from earnings?
That's a great question, but I want to keep in mind that the Fed rate hikes have a lag effect, and the lag effect by historical standards should be hitting us right around Q4 and early into Q1. So I think we're also looking at the recent wage gains that have happened in certain industries and healthcare, airlines, the autos. There have been specific industries that now are going to be dealing with higher wage costs. All industries are going to be dealing with the refinance of debt at these higher levels and the lag effects for consumers who have run out of some of that excess money. And we see it with the slight rise in delinquency, especially in subprime lending. So we think the lag effects may be a negative factor going forward, or at least something to keep an eye on.
All right, something to keep an eye on. Higher cost of capital, something else that you're looking at right now. But historically, the cost of capital actually isn't that high. It's just high compared to recent times since the Great Recession. Why do you think that's going to weigh on the markets when we are seeing earnings better than expected?
Well, I think if you want to talk about the cost of capital, when you refinance debt that was at 2% and you had an income statement and now you're refinancing at 5 or 6%, I think there is going to be an impact on earnings. I also think that right now we have this Goldilocks with oil having come down. There's been no bad news in the oil market. Look, I said earlier, I'm invested. We're on board. I just think that people are so excited to think that inflation has trickled down and the Fed is going to all of a sudden give this massive amount of liquidity and that it's game on again. I just don't see markets that way. I think there's always something that can percolate. I think that the uncertainty that is created by such an active Fed and this unwind, to think that there's not going to be some impacts. Look, a few months ago, we were talking about banks failing. Nobody saw that. I'm simply pointing out that investors should look at warning signs, be cautious, stay within their risk profile. But sure, as I wrote in my note, enjoy the party and enjoy some punch, but you might want to know what's in that punch before you drink too much of it.
All right, so Mark, one thing I want to talk about, you're actually hitting on it right now, the Fed. Wall Street Journal and Bloomberg both out with reports yesterday saying that some people are pricing in cuts as much as 2.5% from the Fed next year. How much of that is powering the rally that we've been seeing? Obviously, yesterday was a pause in the rally, but how much of that do you believe is behind what we're seeing?
Well, where are those rate cuts going to come from? You just said earnings have been strong. And yes, the consumer's slowing a bit. But do you think after the debacle that the Fed caused with inflation, they're going to run out and lower rates 2 percentage points? We think they're going to be very cautious with giving candy to this market again. It's not going to be the 2008 to 2021 period where it was unabated liquidity, which led to this massive inflation spike and what we're dealing now. I think it's far more optimistic. I think we have an economy that's reasonably strong. It muddles through with some issues, but not enough for the Fed to say we are lowering rates and reversing the actions that we fought so hard for. And I think investor expectations should be managed, especially in the area of lower rates. Look for more level for longer, not lower.